Hey everybody, in this video we're going to talk about the Fed's mandates. That's right, the Fed has mandates. The Fed is not all powerful. The Fed has a boss, and that boss is the U.S. Congress. That's right, the Fed, it didn't create itself. It has a creator, and that creator, again, is the U.S. Congress. And that U.S. Congress created it and actually could destroy it, and that legislative body, known as the U.S. Congress, also has given the Fed its mandates. Now, here's the thing. It was created in 1913, and the reason it was created really was to be a lender of last resort to the banking system. You see, the Fed is the U.S. central bank, and it was supposed to sit behind the banking system in times of crises, lend generously to those banks that were illiquid because of the banking panic, but solvent, assets worth more than their liabilities. But anyhow, I'm not going to go any further in that lender of last resort. We'll have a different video on that. I just want you to know by 1920s, the Fed started to move into the area of monetary policy as we know it, which is changing the money supply and interest rates through open market operations. And that role and in doing monetary policy, again, changing the money supply and interest rates in the economy to affect the business cycle, to really moderate the business cycle, just continued into the 1930s, 40s, 50s, 60s, and 70s. And it was in 1977, the U.S. Congress, the boss of the Fed, said, hey, let's formally give you your mandates in regards to monetary policy. And here are the mandates: price level stability, maximum employment, and moderate long-term interest rates. That's right, there are three mandates, and which might be a surprise to many of us because we only hear of the dual mandate. We act like there's just two mandates, and the reason why, and it's a pretty good reason, is basically economists say if the Fed does the first two mandates, price level stability and maximum employment, that will take care of the third mandate, moderate long-term interest rates. Here at Econ Busters, we like to say if they fulfill the first mandate, price level stability, that will probably take care of the third mandate, moderate long-term interest rates. So we're not going to talk much about moderate long-term interest rates because, again, economists pretty much agree first two mandates fulfilled, that takes care of the third mandate. So they talk about a dual mandate. That's right, the two mandates, price level stability and maximum employment. And those ones have a tension with each other. It's not that taking care of one takes care of the other. No. And that's why there is a dual mandate. And that's why we talk about this tension. They're kind of inversely related to each other. And what I mean by that, in case you didn't know what inverse was, what I mean by that is, hey, if inflation becomes a problem, the inflation rate ticks up too high. That means we're not having price level stability. And the Fed needs to bring the inflation rate down. When they bring the inflation rate down, a positive inflation rate down, known as disinflation, the unemployment rate tends, not in this last little bout of disinflation, but usually history has shown the unemployment rate ticks up a significant amount, okay? So bringing the inflation rate down causes the unemployment rate to tick up. And if we're in a recession and the unemployment rate is high, not at maximum employment, and the Fed tries to bring that unemployment rate down, the things they do to bring the unemployment rate down cause that inflation rate to tick up, and we lose the price level stability. So again, there's a tension between those two mandates. But before I go any further, I want to kind of put some meat on the bones of these mandates, because these mandates, they were legislated into law by the legislative branch, which basically is known as giving kind of like a broad law or objective to a bureaucratic entity. And the bureaucratic entity is the Fed. That's right. The Fed is an independent regulatory agency, okay? But that means it's basically a bureaucratic agency. It is there to execute the law of the U.S. Congress, and to do it with discretion based on their expertise. And so they got this law from politicians basically saying price level stability and maximum employment, and they said, okay, let me redefine that a little bit, okay? So the way they have currently, now this didn't even really happen until 2012, redefine the price level stability is an inflation target of 2%, which is really kind of interesting, okay? Economists like to talk about differences between levels and rates, okay? So price level, which is the level of prices, and the inflation rate, which is what is the rate of speed at which the price level is going up. And so the Congress said price level stability, okay? Well, a lot of us would think of, well, price level stability, that means we're just going to have the same price level. And the Fed said, no, okay? If we interpret price level stability, if us bureaucrats with expertise interpret price level stability as a 0% inflation rate, that is really problematic. That's too low of an inflation rate. There's lots of problems with that low of an inflation rate. One of the biggest problems is it's just too doggone close to deflation. And if you fall into deflationary times, you get a huge drag on spending because deflation means prices are going down. And when prices are going down, people delay purchases because they think prices are going down, and their delaying of purchases causes prices to go down even further, which causes them to delay. Anyhow, deflation really bad for the economy and causes unemployment, causes recessions, causes unemployment to go up. And so the Fed said, you must not mean price level staying the same. We're going to reinterpret your price level stability as an inflationary target of 2%. Now, I have another video on why 2%, why not lower, why not higher, so I'm not going to go into that here. I just want you to know price level stability reinterpreted as an inflation rate of 2% because really they wanted to not be too doggone close to deflation, so 0% wasn't going to work for them. Next, maximum employment. Now, every economic student is supposed to know we can't get to an unemployment rate of 0%, okay? First of all, we have natural types of unemployment, okay? What are our natural types of unemployment? These are types of unemployment you're gonna have no matter what. Whether you're booming, busting, you're always gonna have them. And what are the natural types of unemployment? They are frictional and they are structural. Frictional has to do with the fact that we have a two-way match thing going on where we have a job opening or an employer or a prospective employer, and you have a job seeker, a prospective employee, and they're trying to find each other. And two-way matches take exponentially more time than one-way matches. And so we're kind of need some search time. There's always going to be search time is what I really want to say. As long as we allow businesses the freedom to pick their workers and workers the freedom to pick their businesses, you're always going to have this search time happening. So you're always going to have some people unemployed just because of the freedom that we allow in our economic system, okay? So you're going to have frictional. The other thing is you're going to have structural unemployment. See, our economy is structured in such a way at any given moment in time that certain skill sets are demanded in certain quantities. But what happens to the structure of our economy all the time? It changes. And anytime the structure of your economy changes, the skill sets that you now have in demand and the numbers that you are demanding them have changed. So some skill sets are going to find themselves in surplus. You know what this means. Usually kind of like an innovation type thing, right? We automate something, innovate something, and so certain skill sets are not needed as much as they used to. Now they're in surplus. And so we're always going to have that. Why? Because the structure of our economy is always going to change. So again, we are always going to have some unemployment. Boom times, bust times, anytime, we're always going to have some unemployment. Those are the natural rates of unemployment. And so first of all, maximum employment is not going to be interpreted as an unemployment of 0%. It's going to be a positive amount. Now, the other thing where these two mandates really come into play has to do with this thing and really kind of this thing right here. Now, what is this? This is the Phillips curve model, okay? I've got inflation rate, okay? Inflation rate and unemployment rate, which should make some sense, guys. Okay, we got the dual mandate, price level stability, interpreted as an inflationary target of 2%, and we've got maximum employment, which has to do with the unemployment rate, okay? Now, you have a short run Phillips curve, which says in the short run, over short periods of time, there's this inverse relationship between those two things, which we've already talked about. If I want to bring the inflation rate down, the things that I'm going to do, which is cause people to spend less, basically, is going to cause unemployment to tick up. And the things I'm going to do to bring down high unemployment, which is get people to try to spend more, get institutions to spend more, is going to cause the inflation rate to tick back up. There's that inverse relationship in the short run. Now, that relationship kind of breaks down in the long run, and here's why. There's this thing called the NAIRU, okay? Non-accelerating inflation rate of unemployment. I know, mouthful, but just stay with me. The non-accelerating inflation rate of unemployment. The lowest the unemployment rate can get, maximum employment, without the inflation rate, price level stability, beginning to accelerate upwards. Let me say that again. The NAIRU is the lowest the unemployment rate can get, without the inflation rate beginning to accelerate upwards, okay? So the NAIRU, also known as the natural rate of unemployment, is what the Fed has interpreted the maximum employment mandate to mean. Oh, Congress, when you said maximum employment, well, you meant maximum employment consistent with price level stability, and the lowest we can get the unemployment rate consistent with price level stability, low inflation rates, is the NAIRU, okay? The non-accelerating inflation rate of unemployment, the natural rate of unemployment. And let me just make sure that you understand that, okay? So here is the thing, is if you're over here, your unemployment rate kind of high, it's above the NAIRU, the Fed is supposed to bring it down. And when they bring that unemployment rate down, again, by trying to get people to spend more, okay, the inflation rate, you can see, begins to tick up, all right? Now, what some people say is, well, how about if they continue to get more spending and more spending and more spending and get that unemployment rate even lower? How about if they try to interpret maximum employment as something lower than the NAIRU, okay? Well, that would push us over here. Oh, well, that might make us accept a little higher inflation rate, but maybe that's okay. Maybe we should go with an unemployment lower than the NAIRU and a little bit higher inflation rate. But here's the point I want you to hear. This is not a durable spot. It is not a durable spot, okay? It is an unemployment rate below the NAIRU. If we get to the left-hand side of this long-run Phillips curve, okay, the inflation rate will begin to accelerate upwards. We won't stay there. If we try to stay at this unemployment rate, okay, an unemployment below the NAIRU, remember, what have they been mandated with? Maximum employment. Maximum employment. Well, is that the NAIRU? Is that an unemployment rate of, say, I don't know, 4.3%? Let's say that's what the NAIRU is right now. Shouldn't they go for something lower than 4.3%? Well, if they do, and they get us here, we won't stay there. That's not a durable place we could stay. The inflation rate will not just tick up, it will begin to accelerate upwards. That's right. And when we go there, it will begin to accelerate even higher. Okay, again, what is the NAIRU? The non-accelerating inflation rate of unemployment, the lowest the unemployment rate can get without the inflation rate beginning to accelerate upwards. Hey, I've got two mandates, price level stability, okay, and maximum employment. Well, I can't interpret price level stability as a 0% inflation rate, because if I do, I'm probably going to end up causing lots of unemployment out there. So that's not going to be consistent with maximum employment. Now, let me look at my maximum employment mandate. Well, if I interpret that as incredibly low amounts of unemployment rate, that's not consistent with price level stability, because my inflation rate will begin to accelerate upwards. So I have to find a balance. You remember, I'm a bureaucrat. I have bureaucratic discretion because I have bureaucratic expertise. I'm the economist. Those were politicians. Now, when I'm saying I'm being the Fed right now, right? Those were politicians that mandated this. And so I need to go with the law's objective, okay? Not the letter of the law, the law's objective. I have to interpret the law so that I can meet the objective of the law, which was to the Fed's, the Fed is basically saying, hey, what you really want is just price levels to be really, inflation rates to be really low and the unemployment rate to be as low as I can get with inflation rates that are low. So again, how they have interpreted their mandates of price level stability and maximum employment are as follows. Price level stability, not an inflation rate of 0, i.e. price level staying constant, but an inflation rate of 2%. That allows us to have a little kind of juice spending a little bit, kind of grease the oil of the machine so that we can continue to kind of like promote growth in our economy. It's not going to stagnate our economy like a 0% inflation rate, but also an unemployment rate that is positive. In fact, is as much as the NAIRU needs to be, the non-accelerating inflation rate of unemployment, which could be, again, around 4.3%, give or take 1/2%, okay? Any lower unemployment rate and the inflation rate will probably begin to accelerate upwards. The dual mandate, there's a tension between those two mandates, okay? There's no tension with the third. We do the first two, that takes care of the third. But there's a tension with these first two mandates. And so we got to take the mandates, the laws given to us by Congress. Again, I'm being the Fed here. And the Fed has to say, okay, how am I going to interpret this law so that it makes sense from the economics that are in the real world? Okay, I'm going to interpret maximum employment as the natural rate of unemployment, okay? The non-accelerating inflation rate of unemployment, which is around, who knows, 4.3, 4.2, 4.1%, somewhere in there. And price level stability, I'm not going to interpret as a price level that never changes, but a price level that's increasing at a rate of 2%. So the price level is going to continue to go up, but just at a low rate. Hope that makes sense to you. We'll see you in the next video.